So what are some of the biggest mistakes people make when getting into investing? In this video, I'm going to share 7 investing mistakes that could cost you thousands of dollars. It's extremely important to recognize and understand these mistakes so you can prevent them from happening and save yourself a lot of money in the future. With that being said, let's get straight into it. So one of the first mistakes to mention is following trends and others. This is a problem many people fall into, and not just new investors. It's easy to let the opinions of others influence the decisions that we make, whether that's through TV, social media, or friends talking about a stock that's been trending and it's seen a lot of growth in a short amount of time. This is not something you want to get involved in, and you'll really just be gambling with your money. We saw a lot of this during the beginning of the meme and SPAC stock craze back in 2021. But regardless of what anyone says, you should always do your due diligence. Invest in stocks that you understand and believe in after doing your research, as well as what's in your comfort zone and risk tolerance. Or you could just keep it simple, invest in the S&P 500 index fund or a total stock market index fund for consistent gains, low risk, and diversification. Trying to time the market is a common mistake that not only new investors make. Trying to wait and guess for the perfect time to get in the market won't do anything but cause you to miss out on the opportunity of growth because you won't be invested in the market at all. I came across an article on Charles Schwab written by the Schwab Center for Financial Research about if timing in the market works. This study took a 20-year range from 2001 to 2020 and compared 5 different investor types. Each one of these investors received $2,000 to invest in at the beginning of the year. This is what their investing style looked like. The first investor had perfect timing and their $2,000 was invested at the exact lowest point of each year. The second investor invested the $2,000 right away on the first day of the year. The third investor dollar cost averaged by dividing their $2,000 over the 12 months of the year. This ends up being about $166 and change each month. The fourth investor has horrible timing and invested their $2,000 at the highest point of the year. And the last investor held on to their cash and chose to not invest anything at all. Now, this article did provide a chart on how each of these investments performed over the 20 years, so let's see how each one did. Right away, you see the perfect timing investor did the best over the 20 years at $151,000. Close behind in second is investing everything immediately. The investor with horrible timing still managed to reach $121,000, while the worst one was the one that had kept the cash and not invested at all. What we can learn from this is that, yes, perfect timing does do the best, but doing this would just be an impossible prediction. And that's okay, because the next best options are a lot more realistic and achievable, which is investing immediately and dollar cost averaging. Dollar cost averaging is one of the best strategies, as you're investing your money on a consistent basis. For example, $400 every month or $100 every week into the stock market. This creates consistency with investing. Regardless if the market's going up or down, you're still actively investing and avoiding any of the noise happening in the market. The third mistake is lacking a foundation before starting to invest. What I mean by that is not having an emergency fund in place and having high interest debt. It's best practice to have around 3 to 6 months of living expenses saved in case of emergency. This is because the last thing you'd want to do is to be forced to sell your investments just because an unexpected expense occurred. This would delay the growth of your investments as well as a tax penalty you'll be paying on the money that you decided to withdraw. Along with having an emergency fund, you should consider paying off high interest debt from things like credit cards. The interest rates on cards are much higher than the average expected returns for the stock market. For this reason, you'd benefit more from using your money to pay off that debt than to invest it. Once you have a foundation, it's important to have a plan in place for investing. This leads to the next mistake of not having a plan in place for investing. And we want to have the odds in our favor. You need to be able to figure out what your financial situation is right now and how much money you can put towards investing. What are you looking to achieve with the money? Do you want a comfortable retirement, maybe live off passive income, or just be able to take some vacations? Whatever it is, it's important to create a timeline of these goals and figure out what level of risk you're comfortable with. This will help prevent you from stepping outside your boundaries of not consistently investing or taking a bigger risk on things that you normally just wouldn't invest in. Build a plan that aligns to your goals and situation so you can better position yourself for the future. Number 5 is panic selling. And yes, that's exactly what you think it is. Panicking and selling due to a big downturn or drop in the market. In this CNBC article based on research from MIT, More than 30% of investors who panic sold their assets after previous downturns never invested again. This is exactly what you don't want to do. Lock in and realize your losses by selling out of your investments during these times. This will likely just scare you out of future opportunities of getting invested in the market again. If you're investing in stable companies or index funds and ETFs, then all that matters is that you continue to dollar cost average into the market. Hold through the rough times and block out the noise. History has shown us that there's always moments of higher volatility when the unexpected happens, whether that's from policy changes, the economy, or a crazy pandemic. As a new investor, you don't want to get caught up with day trading. There's a reason why it's called trading and not investing. That's because you're buying and selling assets within a day or the short term and not over the long term for multiple years. There's a variety of studies and support showing that a majority of day traders lose their money. You don't want to be gambling away your money with hopes to make a lot more money fast. Also, with day trading or short-term trading, you'll have short-term capital gains tax on your earnings. That means the gains or profits that you make on your trades will be taxed at your income rate. So you'd have to be doing well beyond market returns, as the tax itself will be taking a chunk out of your returns. Long-term passive investing has a lot more benefits: how it's taxed, less active hands-off approach, statistically better for most investors, and consistent returns, as well as being a lot less risky. The last mistake is not utilizing tax advantage accounts. It's a mistake many new investors make simply just because they don't know about it. This can be split into two different categories. That's tax exempt and tax deferred. Tax deferred is when taxes are paid in the future. For example, once you withdraw your money from these accounts at your retirement age, that's when you'll be taxed. Traditional IRAs, 401ks, HSA are examples of some tax deferred accounts. Tax exempt accounts such as Roth IRAs or Roth 401ks, the money you invest with is with after-tax dollars. But once you reach retirement age, the withdrawals that you'll make will be tax-free. Now imagine, how much money would you be able to keep in your later years by not having to pay taxes? That could range from 15 to 30%. That's a big hit that you could dodge in your retirement if you take action in advance. I know many new investors are getting started through a variety of trading apps like Webull or Robinhood, and there's nothing wrong with that. But remember, brokerage accounts are taxable accounts. While you do have more flexibility and less restrictions than a tax advantage account, you don't have any of the tax benefits mentioned. For this reason, you should be trying to prioritize investing in a Roth IRA for tax-free benefits, then your other tax advantage accounts or brokerage accounts secondary. And if you're wondering, where can you open a Roth IRA? There's a variety of brokers to choose from, like Vanguard, Charles Schwab, and Fidelity. I hope these 7 mistakes are something you can look out to avoid. I'd like to hear from you guys. What mistakes have you made? Don't forget to hit the thumbs up if you enjoyed the video, subscribe to see more videos like this, and I'll see you in the next one.